Perfect. Well, welcome to our Saturdays of this Thanksgiving, really before Thanksgiving session of our RM Smart Investing market analysis. This is my actually favorite week of the year. It's something that I look forward to because there's just so many things that make it so special, and it is. Uh, for the longest time, I didn't have a family, so it was me and my friends, and they became my family. So they became my blessings, really. And now that I have a family, it's just wonderful that it's actually growing, and my friends have been my family. So it's a great time of the year, and of course, it doesn't hurt to be in Southern California when it's like really beautiful. I know when I was back east, this time of the year, it will be frozen fields, and we will have the football, American football tradition. We will play flag football or real football on the frozen, muddy fields, and it felt great. Actually, it was nice to be young, didn't feel the cold and freezing. And we just ate the whole week. I mean, the whole day became a whole week. So anyway, in advance, I want to wish you a wonderful Thanksgiving. So uh, another interesting week we had, and the things that are happening. The election has not been finalized, but it's on its hopefully on finality. Also, with this COVID outbreak, there's no end. But then the good news is we have more companies are coming with the vaccination news. And please excuse me. Let me just admit more people. Yeah, it's like a great, fantastic. Okay. Yeah, it's double tasking right now. I miss Sean in many ways right now. So, anyway, so today we're gonna talk about the markets, the economy, and I'm gonna again the lesson of the week. I like to uh, kind of expand it, emphasize some of the lessons that we can actually apply at this moment, and hopefully they are applicable for short term as well as long term. And I had few trades. It was pretty active week for me last week, and of course the option expiration, which was Friday, which was 20th yesterday. It's always active for me. So I will discuss that what we did. So that in mind, I'll start briefly about the economy. We go to the markets, and then we talk about lesson of the week, and then I'll end it at the trade of the week. All right. The economy, basically under the hood observation, I call this. And the numbers, as you can see, in some ways are improving, but also on other hand, we have the second wave again from Europe and then United States. I know state of California actually tonight is being the lockdown, and we are told I think it's the 10 from 10 o'clock or 10:30 till 5 a.m. Unless you're an essential worker, you cannot be out of the house. So things are changing, and that's till for a month. From a month from today, I think it's December 21st, is that the day they're gonna try to see what happens. I believe 41 counties out of 46, I believe, they are on the lockdown. So it's happening all over. So we don't know how the effects will be. Um, Again, the problem is that unknown. On the other hand, now we're getting some kind of clarity on the other ways with the vaccination news. So these numbers, again, I like to see them because I want to see what is in reality happening. I just mentioned opening, we had like a couple of our members, for instance, they're on vacation uh, this week. So, and another member of ours, he just came back from a vacation. So things are happening, but again, it's that uncertainty is not helping the matter. So one thing I always think about, if this year was not an election year politically, and I've said it for past 8 months, I believe, how I think things would have been different. And I leave it at that. So um, one of the biggest observation that we made is the real estate market, and the single family housing starts is actually up about 14.1% for the last 6 months. And we discussed it last week that again, it seems like from the we're moving from urban to suburban, people are thinking that staying home, so they want to improve on from their house, or they want a bigger house, they want to stay away from the big cities, and um, which that contributes to the actually construction of the new housing. On the other hand, the multiple, the multifamilies and the commercial properties, they actually been down uh, pretty big. And understanding is that people don't want to be in they don't want to be near other families, so they'd rather have single units. Um, One other observation I have is last week again we talked about recency bias, and recency bias I was looking at more of like an investment. So when we have the crisis, immediately what happens? We remember that moment, and we forget about the the past lessons, and we just focus on that. So one of the things, these are just my theory, is with the single family housing and other things, it's just we are looking really at this moment, thinking this pandemic will be with us for the rest of our lives. So we have been making adjustments, we are adapting, but this is a dynamic society. So I don't know what's going to happen a year from now, for instance, and whether it's going to get worse or going to get better. So, but I believe obviously the markets, real estate markets, are taking advantage of this. But I don't know how much of the lasting effect it's going to have. For instance, the permits, new housing actually has slowed down. So, anyway, this is just, but we're taking a picture. We're looking at what has happened in the last 6, 7 years, and you can see the housing starts, what's going on, which is pretty strong again. Um, Again, with the interest rates also, that has been a big factor. So as you can see, that has really help the activities. And you can I have friends and I know most of you know someone who's in mortgage business and real estate business, especially in mortgage refinancing. They just cannot keep up with it. So I don't think we in our generations we've had anything like this. It's fantastic to have this cheap money, which brings us, how long can this last, and how long can Fed can keep this low interest rates without the consequences? And I've mentioned it before. We might have a reset because it's the debt looming. It's someday we have to do something. What again, the emerging developing countries like Turkey, Argentina, Zimbabwe, Russia, they've all done. Are we going to default on our interest payments? Or what are we going to do? Of course, being the dollar, that's going to be a little more difficult. But is there's going to be something in a more of an organized way with the Europe and China? And I don't know, because this cannot last too long. So um, with that in mind, let's look at the markets that we had. One of the things I start again is the sentiment. It's important to me. Again, I look at the extremes. This is just for your own observations. As you can see, we haven't had the complete extremes, but we are in more of a positive for a few reasons. Number one, the markets are up. Now, the feeling is that the election is over, the vaccination is here, so there's that positiveness. The other thing is obviously it's the seasonality. Usually November and December are the strongest months, and what happens, the spirit is there, and people start thinking about less about troubles and more about the outlook, a positive outlook. One of the interesting things is that these are the American Association of Individual Investors, and this is as of November 18th. You can see that the big movements. Last week we had like plus 17 in the bullish column, and now we lost about 11 and a half, which majority of that went to neutral. So we really still are less bearish than average and more bullish than average. So I am a contrarian in heart. It had in crises that's paid me handsomely. When the things are wonderful, sometimes it has hindered my performance, but that's what I am. I look at the extremes. I look at the rubber band kind of uh, going back to the means. I look at the opportunities than that. So I look for the extreme. So I always watch for the sentiment, from the momentum, from the as far as the psychological way how the people are reacting. And this year has been very interesting, and we'll discuss it more in the lesson of the week. How the again we call them retail investors are really not dictating. And I mentioned a few weeks ago how actually the institutional money is following the retail investors, especially in the options market, and they're pushing it up. So we'll discuss that a little later. So here was the week. I'll start with the, it was pretty flat in a sense, almost every single index. We were down 0.73% in Dow Jones. Industrial, we can see we are at 29263, and we will notice that 30,000, that round number, has become a big resistance. On S&P 500, we were down again about 0.77%. NASDAQ, finally, technology came back, and thanks to Tesla was the big news, joined the S&P 500, which was expected. We were thinking of it in September. Well, it happened. So NASDAQ was up a tiny bit. And basically, when we look at uh, all the indexes, nothing really stands out except the Dow Jones Utilities. You can see that there was a big drop of 4%. One of the reasons could be, again, the behavior of the interest rates, and also being the defensive oriented. So that was one of the things that stands out. So more of a, this is for risk off, and it was actually down while the markets were down. And on the other hand, you can see the small cap, as well as, again, the Russell 2000 small cap, they continue outperforming the market. And the main reason was, as you can see, that the Pfizer news gave bigger hope, and it's more of economic sensitive stocks are the ones who are benefiting from this. And because of that, the money is basically transferring from big cap, large cap technology going to more industrial and economic sensitive, which you will see in detail how they're working. The advanced decline line still in the positive, so there were more money coming into the market to the more issues. But the dollar had, as you know, it was weaker, then had a little bounce, and it still is pretty flat. Actually, the 92 number and then the 90, those are big numbers, and we will see why I say that. That treasuries, the bonds, actually, they had a nice rebound. They, because of, again, related to the markets. And what has happened with the, if you recall, the Treasury wants their money back by end of the December. So obviously the Fed is not happy with that. They think we need a stimulus. And what that program was for, mostly for mid-cap companies. And I don't know how successful that was, but Treasury said, we want the money, pay us back. And it's December 31st, you've got to do that. So that affected, if you recall, the last day of, I believe it was the Wednesday or Thursday, the markets really dropped. It was Wednesday, I believe, and then Thursday continued. So that was one effect. And the other thing is, I think the big news is these unemployment benefits are going to be running out in the next few weeks. So that's another thing that they have to come up with a solution. So that's from the economic point of view. The oil market had a nice rebound after, again, we're looking at the COVID is dampening the demand. And one interesting thing is that inflation number, and inflation number actually has been peaking, or I mean, it's going up, while the gold, on the other hand, was going down a little bit. And we will look at the charts. I think that will be easier to see. So as you could see again for the week, the surprise has been, since the 2 weeks ago I mentioned the worst performing sector was the energy sector, and still down 39%, but they were up again 5.4%. The cyclicals, the economic sensitive, industrial, basic material, financials, which are the big contributor to Russell 2000, they were all up nicely. On the other hand, it was interesting again, the utilities, but the healthcare, the real estate, and the consumer defensive stocks and communications, they were all down a little bit. So I thought this would be an interesting segment just to review, now that we are in November. If you had this discussion end of March, in April, and you would look at the whole market, the idea of what this COVID could do and what it has done, and look up and say, how could S&P be up for the year, actually close to 11%? And what are the reasons behind it? I thought let's review that, just a few of my ideas that I think that's one of the, again, the reasons, and I want to expand on them to see, is there a separation of, they call it Main Street and Wall Street, and what has happened? So the first reason that we had looked at, and it continued till recently, till September, was the big five, right? So we had the Facebook, Apple, Amazon, and we had, as far as Microsoft and Google, those are the big components of S&P 500, they are big components of NASDAQ, big components of Dow Jones Industrial Average 30. So with S&P 500 and NASDAQ being a market cap weighted indexes, obviously big stocks had a lot more power. And in reality, we really needed these companies. I mean, we look at from Apple to Amazon, we're looking at the Microsoft, people staying at home. We needed that technology. We needed the flexibility and the movement of the retail stuff through Amazon. So basically, in the Facebook, you're at home, Google, you need that communication. So what happened, these were the big factors that the markets actually really, first of all, when they went down, it was initial, again, shock. But after that, it basically the help with these companies because of, again, just based on the need. The second thing, and I emphasize it from the first day, you don't fight the Fed. The flood of money that came in trillions, and again, buying back the bonds and all the stimulus, all that obviously with the 0%, and cheap money to borrow, that also obviously has helped the markets, because you have to remember, I've said it before, money is like a river. This money is fluid, looks for the opportunity, just moves around. So if the opportunity is in the stocks, that's where it's going to be, because there is no really attractive rate of return on your investments, let's say in fixed income. So that's what it has found the best place to go. Dollar was not as attractive. Even gold and silver, which have done well, they were don't really other alternative is the real estate. So basically, there are not many other alternatives. So the money had gone to the equities. The third part was the government stimulus. And with that government stimulus, with that the funding that came in, the consumers started spending. And we talk about, for instance, in the transportation part of things, you see some of those are all-time high when we look at that. And basically, retail has come back, especially, again, e-retail. And because of people not going out, we are not really leisure spending, is staying actually at home, watching movies or improving our our homes, and basically finding more toys. So that was the third reason, which helped the companies. The fourth thing is, because of that, again, concern of how deeply this will affect us, it was the companies learned to cut costs. And because of cutting costs, obviously they became lean. They let, unfortunately, They had to furlough a lot of their employees. But because of that, the bottom line looked attractive. The fifth thing is adopting by public. And I think people are now more accepting of the new way of life. They are adopting to that. They don't have to go to concerts, well, events. On the other hand, I believe we are a social, uh, let's say social animals. We need interaction. So I don't know how long this will last, but it is something to be concerned with. I add a couple of more things, and actually, I think those are the real reason for at least for the stock market. These were like more of an underlying. As a portfolio manager, when you are in especially on the microscope, performance is everything. Now we shall see this next month and a half, and we will work on more of an end of the year. Hopefully, we will have a class on end of the year trading strategy. A lot of these money managers, they get their bonuses, and what happens is more about window dressing, and it's all about performance. So what happens, a lot of money managers, they really have gone away from the real fundamental analysis of companies and really the economy. It has become more of a where the price is. And that's probably one of the reasons, and you shall see, and we will have an example in the trading lesson. It's it's very much price driven, and that's what I said. The retail investors have dictated that, and that institutional following. At this time, they really don't care what is the fundamental of the company. All they want to know, they want to make sure they're on the bandwagon, and they want to have their bonuses. So I went through this, and I shared that story in late 1990s. And we got like Sanborn, he was from the Oakmark Value Fund, Oakmark Fund, and he got fired in 1999. There were few brilliant value investors, and the reason was that at that time, the market was very much growth and momentum oriented. And they were looking at the value. And because they were performing 15, 20%, they they were fired. They wanted 100%, they wanted 50%. So the demand was very short term. And it goes back to my recency bias. We look at what is in it for me today. So I think that's another reason that you have seen this momentum at few stocks. When I look at the options activity, let's say when we can look at the CBOE or the CME, or we look at the options or OCC, you can see there's about 37 million option contracts every day is transacted. Out of that, majority of that is within 10 holdings. And we got thousands of holdings as far as the options, and there's only 10. So there's the S&P 500, for instance, the largest from the ETF point of view. Then you look back and you look at Apples and Teslas, and you look at the big, again, like Amazon's. And what happens is all of these companies, and then on the ETF side, besides the S&P, we have the QQQ and IWM and EEM. So those are the majority of so the money is really concentrated in one place. So at that time, if I'm a money manager, that's what I'm going to focus. If there's this bargain somewhere that it's going to give me money in 3 years or 2 years, and I have to do all the work and I'm not going to see the return, but it doesn't attract me, because again, the institutions are looking for immediate gratification, and then the money managers are looking for their bonuses. So I think that's another reason. And obviously, again, retail investors have played a role because of not their home access to the internet, access to the computer. It's the mobility. We are really have become more of aware of what the markets are doing. Unfortunately, I think fundamentally there's a lot of work to be done, but right now we are just on the bandwagon. So there were just some of my thoughts of why, if anyone asks, I think this could have been, again, the liquidity and also the momentum. So with that in mind, I'm going to go quickly over these, because one thing I want to remember, I repeat the same charts every week because I want your eyes to get used to this. We emphasize the Bollinger Bands. We talked about stochastics. Again, I approach it in a different way than usually it's done. I spoke about it last week. This week, I added the RSI, and I think that might be timely as far as when we talk about divergence. I think that's important. So it's not just about absolute numbers, and the question came about last week. So this is a good way. This is my favorite oscillator as far as momentum indicators for the to see if there is any divergence, if the, the underlying asset is going up, but the RSI is going down. Well, that gives me a heads up. So we look at the ES, which is the S&P 500 mini futures, and you can see that the all-time highs that we've had, it we broke above that, and then if you recall that Monday with the vaccination, we see this big wick or the tail, and then the Bollinger Bands were actually expanding. So we've gone back, touched that, and now we're just sitting on that. We have that February's um, high actually. So basically in the September, and then again we are trying to work this out. We want to digest what's going on. The volume for last week was pretty low when I looked at so there is still wait and see, and we'll see what happens. And the same thing with the YM. I have this magic 30,000. We hit it. We tried to break above it, but most of the time we still embedded. But once we break down, become overbought, the market usually likes to go from the upper Bollinger Band to the lower, to the 18-day or 20-day moving average. So right now we are not overbought yet. We still embedded, so there's a chance it could go back up. But if it doesn't, then it would like to go to that 18-day. One thing you can see, the Bollinger Bands are opening. So once they start opening, they tell us that the momentum is favoring us to the upside. But once it starts flattening, then that's indecision. So we'll see what happens. So then Monday is an important day. Um, Nasdaq, the same thing. Nasdaq has been pretty flat, as I mentioned. The rotation of the money going to the small stocks, and you can see the RSI. We Although we are flat, the RSI has been going a little lower. So it's just a food for thought. The resistance still holding. We had that all-time high. And on the other hand, Russell 2000 has had a really nice move again from the vaccination point of view. We had this big wick, and we still holding that under that high, and we still embedded. That means that the momentum is still with the bulls. As far as a 10-year note, this is, again, it's very important. I mean, you really have to understand the interest rates if you want to be successful equity trader. So although we've had really quiet moments the last few weeks because of the election and other, basically with the COVID news, and not thinking that the stimulus package will not be as big, or is it going to be hot? What is happening again with the election in Georgia and all that. So we've been back and forth with the interest rate. So this week, you can see we've been pretty flat, and we had a little, up movement. Honestly, but we hit that lower Bollinger Band. We were embedded and became oversold. And once we're oversold, then we like to go and kiss the 50-day moving average, which we have done. Now, actually, with the stochastics, the momentum is upward. So once we pass that the 50, the momentum could continue. So that's as far as the 10-year. I want to show you the cash S&P 500, which is a little different than futures, but the charts are pretty similar. The volatility index, as I had mentioned before, I mean, with the markets being all-time high, really all the markets hit the almost all-time high. The VIX should be in 12 and 13 or 9 actually, but we're still up there. There's still uncertainty. We're sitting right at our support, so they haven't given up. I've mentioned, anything over 15 used to be, oh my God, there's volatility, there's fear. Now, you know, 20 becoming a norm, and we are above it, 24 zones and uh, 23.7, and we're just stabilizing. So right now, the volatility has compressed, but we are not out of woods, although we are embedded on a sell side. So that means that we still have work to do. The volatility is on a bearish mode right now. And then this is the VIX, which is the volatility of VIX. And anytime it's over 100, especially 110, I'm always concerned that the volatility could come back. So you see the divergence here. We've had um, and here. So you're just sitting on the 100-day moving average. Um, the most important thing I think we have to concern is the dollar. So one thing is the dollar is really, you can see the Bollinger Bands are compressing right now. So it's indecision, but this, as I mentioned, 92 and 90 is huge for me. It's because once we break that down, that's gonna giving us again more inflationary pressure. And I would watch then the commodities side, and I would watch again, like for instance, euro and like say Aussie dollar at that time. But it's been pressing again. It, if we had more favorability as far as like Georgia going to the Democrats, now I think at that time we're going to look at obviously a more inflationary pressure, more stimulus. And I've mentioned it in the last few months, again, last 8 months, I think the decade of 20s would be favoring more international holding than domestic holdings, in my opinion. Um, Also, the oil held its support, and we are really just floating around our 100-day moving average, and we embedded in stochastics. Um, Now, gold is an interesting story. So imagine what happened that one day gold hit that first, the lower Bollinger Band, and we came back. Now, this 18 days are becoming our resistance. So uh, I keep repeating myself. I don't mind the gold having another leg down, because I think in the long run, I'm talking long run, I'm thinking about next 6 months or 8 months, gold will outperform the market. So I'd rather have bargains in gold. So I look for opportunity to buy more. I would buy either like GLD, or I would buy more options and long-term options on gold. But or you can buy coins or bars if you like. But that's what I'm awaiting. Right now, we have this support here, but in order to have confirmation, if you're not going to go down anymore, we need to break above the 18-day and then the 100-day to have the confirmation. Silver actually looks a little better than gold because we are at over the 18-day. And I had mentioned before the potential for silver, especially again being a little more economic sensitive in the sense that, especially with the alternative energy, and then maybe with the economy, if the vaccination works, so it will favor them. But they really have underperformed gold for a long time, since 2011. They have much more room to improve up on. So I am for gold. I mean, for silver, I've been waiting for the $20 SLV, but somewhere around $20. I would be buyer of silver, and or I would actually sell options if you want to. I think I'm against I don't like to do like naked puts, but if you don't mind, you have the capital to hold silver for a long term, I wouldn't mind when we get close to that SLV, close to that $20 area, then I will sell puts, and I would collect a premium. And if I own I own silver at 20, I'll be happy with that. So, um, and look what has happened. A few weeks ago, we talked about copper right around here. Again, it looks like with the China news, on top of everything else with vaccination, that has been moving up nicely. Now, a couple of stocks that we've been working on, and I've played options quite a bit on one of them. The Southern Copper with SCCO has been doing fantastic, and also Freeport McMoRan, which is the largest pure when you talk about copper. FCX has done very well, and I've been um, pretty happy with our holdings in the options with the Freeport. So, but this is what has happened with copper, which is more economic sensitive. Now, I hope you enjoyed that Bitcoin class that Sean did wonderfully, and that was it was really informative. So, of course, after that talk, Bitcoin continues going up. It's almost going to hit its all-time high, which was the second week of December in 2017. It was almost $20,000. So I will refer back to that our class on Wednesday to learn a little bit more about the Bitcoin. But this is a nice chart. We call this railroad track, just for your information. You can see we're kissing that upper Bollinger Band. We are not deviating from that. We're just hugging it and we're just moving up. So it looks like a railroad track. You see these candles going up and down, but they're not really deviating from that. They really love it's almost, we call it parent-child. So they are they want to be the children, they just want to be hug their parents and stay with them. And that's what has happened since we had this is another, we had this squeeze, really. That was the squeeze. We knew something's going to happen, either up or down, and decided the momentum went up. And as you can see, this is the reason I think understanding stochastics the right way, it will help you to be on the right side longer than if you use the traditional way. Now, stochastic is, obviously it's over 80. So in the traditional books, it will say, well, it's overbought, you got to get out of it. In this situation, actually it shows the strength. So I've used this embedded, it's over 80, that's a good sign. And as long as it stays above it for 3 days or more, that means the bulls are in control and you don't want to be out of it. At least definitely not, you don't want to be shorting it because you have a lot of strength. So if you would have followed just the stochastic part of things, you could have seen that there was no reason to sell. And that's the reason you've been above the 18-day. Although you're kissing the upper Bollinger Band, that doesn't mean you are really overbought. You keep coming back inside, but the Bollinger Band is just expanding and it's just continuing. So as long as it's up there, as long as the slope is going up, it doesn't mean we are overbought. Now, something could happen, but whatever reason, event driven. But from the technical point of view, right now, this looks like a nice chart. And of course, there's more demand coming. And as I mentioned, here we are. And then obviously RSI looks overbought, but that doesn't mean that it has to be shorted or sold. Okay. I also just want to briefly look at the S&P just on a weekly basis. Again, we've been hitting the resistance, and we'll see if we can break through it. We are nicely above the 18-week moving average, and we are above the support, but we are overbought right now. So in order to next 3 weeks, if this turns down, then that means minutes goes to turns down, then that means, especially with the RSI, then the markets might take a breather. And that would be one sign for the S&P at least. I'll go quickly over the expected move. As you know, this is based on the 1 week, the option market makers, what is their projections for one standard deviation. We always start with the S&P 500. Last week was about 82. This week is about 67. And why is that? Because we are closed on Thursday. Now, being Thanksgiving weekend, just expect a low volume. One thing is people are not really going away, but they want to maybe slow down. They want to be with the family. So usually historically it's a low volume. We will discuss that more in our our lesson of the week. So So this is, I just thought visually, you can see um, the markets this week, we stayed within our expected move. Uh, but some of our other ones they haven't. So we'll see. The QQQ also did. So it was again this was a pretty flat week as you recall. So but we did stay within our expected move. So that would have been a good time for like having a butterfly, for instance, and strategy. The Russell 2000 being the strongest, and this is driving again the option that the market makers driving them crazy, and that's why I think the retail investors are in control in some of these. So for this week we stayed, but we were in the upper side of it. As you can see on Wednesday, we tried to break above and we just stayed inside of it. So um, as far as this is the bond, 20-year bond ETF, it was a strong week for the bond. So they actually had we went on the upper edge. It had been, again, we've been really outside of it all this time. So it has not been the best um, market to actually uh, be more predictable. So that's what was expected move. Gold went to the lower edge of it, and I will discuss my trade of the week part of it. So you can see we touched the bottom of it. The problem with gold was, I will explain that the trade of the week was that could have easily actually break down because of the last few weeks. Again, you can see it's been outside its expected move, but I usually have a trade every, toward end of the week, which I just discuss it with you when we do the trade of the week. Silver behaved better and stayed inside its expected move. Um, the last three is just watch what has happened to the energy sector, the XLE. This was the expected move, and I mentioned it's like 2.5 standard deviation, even three. The move was 2 weeks ago. Last week, again, we've had a big move outside. So the money is flowing in. These are bargain hunters, and again, this is a rotation. XLF, we hit the upper edge of our expected move, and just seems like we're gonna stay within that range again. And last but not least, boring. G used to be the beat of the economy. It was such a conglomerate, had so many things with it, but then it became a turtle. Like really, who would? It didn't move anything, and I think a few weeks ago we talked about it, and um, no, it's just been amazing that the money just. And the reason I talked about there was unusual options activity in GE, and I was looking at when it was about 7 and thinking, you know, this is a good opportunity, and now look what has happened. I mean, it's been outside its expected move, outside expected move, outside expected move. GE is one of the favorites of Robinhood uh, investors, so that that could explain that too. So anyway, you can see this would have been a great option buy at that time. So all right, okay. So let's discuss I have 3 lessons for you today. So one of them I thought it could be timely because of the Thanksgiving. So I thought this is from Stock Traders Almanac. I thought to share that with you. It's one of my favorite books. I knew Yale Hirsch. I know his son is following his footsteps. I've met with him, and they have a portfolio manager who uses there's they call them probability fund. um, Great people, and so I thought it would be timely to see what happens the week before Thanksgiving, and that the week of Thanksgiving actually. So mm, they do have about 35 years, and based on that, since 1988, the Fridays have been up 18 out of 31 times. Again, this is the day after, so you have to be a little bit cautious with the volume part of it, and especially if there's a news driven. We are in an unusual year. And in average, so the Wednesday to Friday, actually, so if you had it bought on Wednesday and sold on Friday, you would have gained the total Dow was up 601. On the other hand, on Mondays, the total point loss would have been 546, which is down 14 out of 21. So it seems like the best strategy will be coming into the week long and exiting into strength on Friday. So basically saying, all right, buy on Monday and sell on Friday. It's all, again, this is just what has happened past 35 years. It's probability. Use your own judgment. This is an interesting year. But historically, when we look at any holidays, usually the days before the holiday, they're usually up. Probably there was 70 to 80%. I believe 4th of July is one of them, which is not as strong, but all the holiday weekend or the big one holidays, they usually have this bullish bias. Just the same thing. That's what we call them, the Santa Claus rally, right? So this is something that just the food for thought. I thought just share the whole history with you. The past, again, 30 some years from, actually it goes back to 1952. Never mind, and it goes to 2018. So basically just to see how the markets did. So you will have the slides. So just for your information. All right. I hope that just something a little time there I wanted to share with you. The second thing I want to share with you is the power of how the options can guide the stocks, not the other way around, not the stocks. So, and again, this is what I want to talk about, again, the retail investors and how the option markets behave. So I want to look at Tesla. Tesla has been a mystery in some of these actually professionals' eyes. It's one of the most shorted stocks because people cannot believe a company like Tesla, which really didn't have any earnings, had a lot of promises, but negative cash flow. It was living on just a promise. How could it be right now bigger than all the car companies combined almost when you look at the market cap? So I thought, let's look at it. I mean, now we are over, in this case, 500. Obviously, from technical point of view, these are my linear regression. Obviously, we are a little overbought here. All the squeeze is just on the third bar. So, but that was not the reason I want to discuss it. I just want to see fundamentally why stock like Tesla can keep going up. So let's use this is from Thinkorswim. I just thought I use the Friday's closing and analyze how the option market could dictate the price of something like Tesla. Okay, so on Friday, the volume on Tesla was about 32, well, almost 33 million. Thinkorswim has something called Sizzle Index, which I've shared that with you before, part of our lessons. And what the Sizzle Index does, it looks at on that day and looks at the activities of the options for that day, the total options volume for all the strike prices, and then compares that for the past 5 days. Okay, so it wants to see, is there any unusual volume activity? So I look at this, especially I've shown you, I think I shared with you one time on how to screen for this, so you can find some candidates that you thought this is a good start if there's any unusual option activity. So this is very important. So you can see when it says 0.43, what that means is actually this 1 million, 1.1 million is actually almost less than half of what it has been in the past. So in the past 5 days. So it's about 2.5 million was the average. So it's a pretty slow day in a sense. And then we can look at what is the call side of things. So there's not much really activity either to the call or put. So this is not the reason I want to look at this. I want to look at, there is about 1.1 and over 1.1 million of options. Now, majority of that you can see there on the call side. So what happens is, let's say there is about, I'm just using a number of 1 million call options. So what happens when somebody buys, or the group of people, in this case it's mostly retail, they buy 1 million shares of option contracts. As you know, one contract is 100 shares. That means there's about 100 million shares of stocks could be trading hands. So what happens when a retail investor buys a call option? You have the other side. Most of the time is usually the institutions, because usually it's the institutions who provide, the market makers, which are the big institutions as well. They're the ones who provide the liquidity, but they are the ones who sell you, and they're the smart money, so they're the one who collect the premium. So majority of people, again, they are usually on the call side of things and basically on the buy side of things. So when you purchase, let's say from Goldman Sachs, you buy one option on, on Tesla. I'm the retail investor. So what that means is Goldman Sachs comes and sells you that. So they are on the hook. That means if you ever want to exercise it, they have to deliver that stock to you. In order to protect themselves, what they have to do, they have to go and buy the number of shares that they are at risk. Now, this is going to get a little complicated. Just bear with me. Although there is 100 shares, and we're talking about one contract, that delta is the most important thing. Delta, when it's positive, that means it goes up with the market. So if the delta of average all of these Tesla is 0.4, that means for every dollar moving stock, there's a 40 cents risk with the option. So what that means is that the option writer, the institutions, has for every $100 has $40 of risk. So they have to, what they have to do, they have to protect themselves. So what that means is they have to make sure that for every one contract that they wrote for 100, for instance, they have to really buy 40 shares to have it in their inventory to make sure they can deliver it to you. I hope that's clear. So if I'm an option buyer, a call buyer, and I have a delta of 0.4, if it was 1, it would be 1 to 1. So for every 100 shares, one contract, I have 100 shares. My other party has a risk of 100. So when you have about 1 million calls on a buy side, and let's say there is 0.4 delta, for every of those, the other side has to go and buy those shares. So the bottom line is, when you have these retail investors becoming so positive and they keep buying these calls, the other party is selling that call, but in order to protect themselves, they are building an inventory of the stock. So they have to go and buy it, and that's by default. It's not like they sat there, Goldman Sachs or Merrill Lynch or JP Morgan, they didn't sit there and analyze Tesla and they said, oh, Tesla is a great bargain, let's go buy it. Because of these option activities, which are huge, they have to go buy those shares. So in reality, what you can see is actually a retail investor is pushing the institutions to actually buy the companies like Tesla. And it happens in spiders and IWM. So I hope that kind of explains as far as how the options market work and how you can see the options actually are kind of forced to move up the stocks. So just a food for thought. All right, no limit of time. All right, the third lesson. I thought this was really interesting. There's a company called it's called Naked, and what it is, it's Heidi Klum. I don't know if you watch America Got Talent. She's the supermodel, German supermodel, and used to be married to Seal, the singer. she started this company. She's part of the company, and it's basically competes with Victoria's Secret. It's more of a like a lingerie, and so this company has been around for a few years. But when I look back, it used to be with all the splits that they've had, reverse splits. They used to be $1,000 company. I've used this as kind of a more of a day trading, and the reason is you can see the moves on something like the stock. So I thought it's timely to visit some of these really tiny. This is it was an 8 cents, 10 cent stock last week. I've traded it a few times, so I thought to share with you um, just an idea of what to do if you see some of the stocks like this. And it's it it was at it hit 33 cents. It went from 8 cents, and I'd like to share this with you. This is where it was. It was at between 8 and 10 cents. About 3 days ago, 2 days ago, actually, 3 days ago, the volume comes in and it just shot up, hit 33 cents. So it went from 8 cents, 7, 8 cents to 33 cents. And then it came down, and then we are at 17 cents. So why do I want to share with you? What is it this 17-cent stock has to do with it? I played it between like 47, 50 cents and $1.20. It was just had a very predictable behavior then it just closed. It was being delisted from NASDAQ because lack of capital. And you will see some stocks like this. And if you go to Finviz, like it says the biggest movers, you will see what is happening. So I thought to share, this is not quiet, is we call it pump and dump. And this was really big in late 80s and 90s. And that used to come through newsletters. So what is that pump and dump? Is a scheme that what happens, somebody pushes the stock, and usually it used to be through newsletter. We have this great invention coming up. A lot of OTC stocks, but a lot of Canadian stocks, they will have like Vancouver listing and then maybe Toronto listing. They were going to come out with the greatest thing in biotechnology. They were finding this mine full of gold, and they needed some investors for the capital, and it is going to be, and it's going to be 1,000% in a matter of weeks. If you ever watched Boiler Room, if you haven't, I would definitely recommend watching that. It was Vin Diesel played, and it's like really, it will kind of make you familiar with that. Of course, the Wolves of Wall Street, that will be another one. So what it was, again, they create a market. So nowadays, everything being electronic, you don't receive these newsletters. But what I do, this is a strategy that I use. I watch for emails, and sometimes there's companies, they look very reputable. They always have somebody who's like an analyst, but you always read the fine line, right? And it says this is, he's getting paid maybe 20,000 shares or whatever. They have to write it because it's illegal. If they don't, they go to jail. So what I do, instead of poo-pooing these things, I actually look for the human emotional psychological behavior, because we all want to make quick money. And so I go for a ride for maybe 2 or 3 days, and I probably miss sometimes big chunk of the move, but I'm happy if we make 200 or 300% or 100%. So how do you find these? As I mentioned, watch for the high volume. And let me go back. Look at this volume. It's 378 million. The float of this stock is 41 million. That means almost over 9 times the stock was turned over in one day. I also look at like a 1-minute chart. So that's what I do. I look at level 2. If you have access to level 3, even better. I look at level 2, and I like to see if are we in the buy side or the sell side. And the other thing I use, if I'm in the beginning of it, I look for a really quiet time, and then I look at for the volume. The first volume, when there's a spike, you will the stock moves, but usually doesn't move as much as like a 100%. It usually moves like 20, 30%. Once you get that warning, then you want to follow up and see if there's any news. Usually, like for this one, there was nothing, no news, or they said something in China. They had some sales numbers came in China. But other than that, there is really nothing. But I look at the blog activities, stock wits, for instance. You can use stock wits, but they used to be Bull and Bear. Yahoo Finance used to have these blogs. So you want to see the initial way of this happening. And usually, again, it's three stages. The first one is accumulations. The first pump, then it corrects a little bit, and then had the second pump, and then it just collapses. So you want to be on the way out. You don't want to be greedy, and that's the biggest problem. So what I look at is when the volume really swollen, then this is the time to be out. So as far as that goes, again, the FinViz will give you the biggest volume movers or the biggest movers. So that will be one start to make sure that this is the first day. But also, as I mentioned, watch some of the blogs, as I mentioned. But before I used to just ignore. I mean, sometimes I've become so familiar with them for the past 30 years, I knew the behavior. But this kind of, even though this is actually a real company, it's not. So all the other companies, they would just lease or rent just a suite in, it used to be in Vancouver. The numbers is the nobody was there, nothing. Alternative energy, the batteries used to be big in early 2000s, for instance. There were a lot of companies like that with new technologies. And so basically, this one is a real company, but it's just, there's nothing. They have no income, no really cash. But at least they're not, they're not empty promise in a sense that they don't exist. They actually exist, but sometimes the companies hire these professionals to come and just pump these. So anyway, I just thought, again, I always look for some alternative rather than just a simple, buy and hold and or sell or just options. I thought to share that with you because you'll see a lot of these, if you're on the look. Again, your whole idea is to be right here, go for a ride. That's why I do, like, again, 1 minute charts, and I look at that. If I made 100%, I cannot be greedy. The last thing I have to tell you, this is very important, is once they start, they have is an extended hours. Huge moves happen. So don't just, let's say you're on the first stage, and I always, some of you know that I always put my targets as soon as I get in, because emotionally I know what I'm satisfied with and what is my target. So, but I always put good till cancel after hours with the plus, because big moves happen after 1 o'clock on these stocks. So when there's pumping, usually sometimes the news comes and there's a lot of volumes happening. So a lot of my sales, believe it or not, either have happened after hours or before the market has opened, like about 5:30 in the morning. I know a couple of you have been a couple of these trades, and one of you, I think, just called me and said, "Oh, Rami, you got hit," and at 5:04, I wouldn't have known. It was like nice of my friend to call me and tell me that at 5:35, for instance, I was hit on my target. So these are I just thought to share that with you. All right. Okay. In the interest of time, I want to move on. So I had few trades of the week. It was a busy week, although it was a quiet week in some ways, but I want to, again, the same, I like to follow the same guidelines we use, because we want to build this habit. We don't want to have 1,000 different things to look at. I want to get to the habit of understanding the daily openings, especially if you watch the futures. If you don't have, like, for instance, this is from TradeStation. Thinkorswim does the same thing, but you can even also do FinViz. FinViz does a 5 minute. So it's just getting the idea what's going on. So what this is, this was the S&P in mini, and the reason I want to show you this is Friday, Thursday, and Tuesday and Wednesday. So I'm going backward to share with you my trades. So on Wednesday, remember the first hour of the market is the most important hour. All the news have come in. The economic news are usually within that hour. Overseas news is already there. Whatever we had, if we had a gap up, if we had a gap down, all of those are being digested within that hour. So so I've mentioned to you about 80% of the time, the market usually makes its high or low of the day within the first hour. So let's observe Wednesday. This was the high of the day. We went a little higher than that, but basically you can see we stayed within high of the day. The low of the day was breached. And once it did, it just continued. You can see that was horrendous day at that time. And this is where Mnuchin, the Treasury Secretary, came and said, we want our money back. So basically, but once it breaks down, the odds are, number one, a lot of times it's range bound. So that's one thing if you want to do option strategy. If you're doing futures or option, once it breaks this down, most of the time, this would have been the high of the day. So having that knowledge, especially if it's like in the middle of the day or close to 11 o'clock, having that knowledge, maybe I would have sold a call. I do futures, but if we want to do calls, maybe this will be, again, from probability point of view, there's an 80% chance that this would have stayed the high of the day. So that would have been one strategy. Or you could have bought a put option, for instance. So that would be one idea. So that's Wednesdays. Now let's go to Thursday. This was the low of the day. We had a little gap down, which is actually is a big gap in a sense, because we gapped here, which I put down the dots here. This was the low of that candlestick. And then we actually closed that gap. And that was the high of the first hour at that time. Again, this was the low of the day for Thursday. We held it. The high of the day was breached, and we went, and then, we finished on the almost close to the high of the day. So basically, again, that 80% chance, once it breaks above that, there's a good chance knowing that, well, this will be the low of the day. So maybe I can play in strategy. And again, these are day trading. This is not for the next day because we don't know what happens next day. I'm just, again, with the futures, you have a lot of flexibility. With options, you have a little less. But with S&P, because you have Monday, Wednesday, Friday expiration, gives you a lot more flexibility from that point of view. We did the Friday again. That was the high of the day. We opened it. There was not much of a gap. So this was the high of the first hour. This was the low of the first hour. Again, a couple of times we tried to break above that. We couldn't. We broke down, and then that was another flood or the waterfall. Okay. So I'm going to go a little faster so we can just have time. Now, this is Tuesday and Monday. So I'm going backwards. So let's do Tuesday. Well, let me do Monday and then we talk about Tuesday. Monday, we had this big gap up. So if you recall, I don't like Mondays. I don't believe in the gaps. This was a big gap. So usually the big gaps on Mondays do not get filled. So if you were playing odds, the half a gap has a lot better odds of closing, obviously about 85 to 87%. I usually like the Tuesday, Wednesday, Thursday odds. This was our opening gap. This was the high of the day for Monday. This was the low of the day for Monday. And basically you can see we never breached the low of the day. We came close, but we closed on the high of the day and we broke above that. And basically, when the market came down, just hit the low and then bounced back. And so that was Monday. Tuesday, now we had a big gap down. So it kind of negated some of this move here. And basically what happens, I've shared this with you again. I will share it again. As you can see, this was close of Friday right here. This was a high of Friday. what we did, we gapped up. As you can see, we gapped up higher than the high of the day. So this is called outside days. So what that means is we were not inside Friday's range. We were actually up. So the odds of the gap closing when it's outside day is very, very low because there's a lot of, again, pressure from the buyers that they had to explode, and that's what happens. On the other hand, if you recall, we just talked about this gap. This gap is inside the range of the previous day. So what happens when you have a gap down and we are inside, it's Tuesday, it's a little professional, it's more than 1%. So I usually like it less than 1%. If it closes below, but inside, the odds of closing that gap is pretty good, at least at 50%. So we came and almost, we didn't completely close it, but the odds are pretty good that, again, this was kind of a professional gap in the 1%, but the odds are good that if it's inside day, we will close that. The interesting part is we actually closed Monday's gap on Tuesday. So basically that was interesting to see. So here was Tuesday, again, the low of the day, the high of the day, the first hour I'm sorry, the high of the day was, believe it or not, was at the opening, the low of the day, and after that, our low just, uh, it stayed, and then we broke above the high of the day. We tried to close, we went back and forth, but we ended up, just staying within the range of that gap. Okay. So what did I do? Basically, it was on Monday. So with my Monday, again, we have that big gap. Some of you know, Tuesday, I look at the markets but I usually, when you have these big gaps and other things, I call them turnaround Tuesday. So my bias, believe it or not, toward on that day was to the downside on on Tuesday. And the reason was we had gapped up. There was, again, big news that Russell 2000 had a nice run. So we were going up. So that was a big day up. So my bias was for Tuesday to go down. Again, that was just based on the experience of the history of what happens on Tuesdays. So basically, I decided to do a vertical on IWM. And what I wanted to do, I wanted to buy the put for 177, and it was kind of a little expensive, and sell the 175 put. So basically, the goal was to collect that premium, and that was for Friday. So this is what I did. I bought the IWM, the 177, that was for the Friday. This is my Monday. This is where I bought it. And I did something that I do not recommend. I always say when you buy the verticals, you want to make sure you sell them together. Don't separate them. But because I've done this enough, I was just looking at, again, this is a no, this is not a good teaching right now. But anyway, I just want to share that with you. What I did, I actually kind of got out of the legs. One of them, actually, I did the leg, which you will see simultaneously. It hit my target. So this was my target. So I got out of this and I covered, but I sold, and I had sold 175. That's one leg. That was a vertical. So I sold 175 put, and I bought 177 put. So this was financing that one. But what I did, I covered one, and the other two, I kind of did a little separate time. So what happened was I ended up making money on both legs. And again, it was more of a hunch, and because it was Tuesday. So rather than doing it at the same time, I first covered, you can see beginning of the day, we had that gap, and then we were going down. So this was the 177 put. I covered everything. I think, it was a 200, I don't know, 100, 150% move. So I got out of that. I covered one of my vertical spreads, and then I ended up holding on a little longer. And then I covered toward end of the day. And that's basically, so this is where I covered my put, and then uh, my long put, and then I waited somewhere around here. Then I covered my at that time they were naked puts. So I kind of made money from both ways. Again, this was just more of a judgment call. I don't recommend, but overall, my whole reasoning was that Monday it was a big move. It was more of emotional event news and driven, and then Tuesday would be a reversal day. So I want to play that. Obviously, with IWM, I had Fridays, so but I got out. I collected as much premium in the beginning of, on Tuesday rather than waiting for Friday to happen. Okay, so that was one. Another thing I mentioned to you with the gold play, I usually do it like end of day on Thursday. I could see there was something we were, if you recall, when I looked at the expected move, we were in the lower edge, and I was kind of hesitant in a sense, but I have this tradition that I do. So I put it on the lower hedge. So I didn't go as aggressively. I think I bought about 10 contracts. So, but I did. It's just a tradition I do. So I bought it at Thursday around 12:45. Immediately I put my targets. As soon as I buy my option, this is what I want to again share with you. My options, I put the 25, 50%. Because it's daily, usually I'm happy with 50 because remember, this is expiring. So I bought it on Thursday and it's expiring the following day. And remember, this theta. Theta is going to eat up a lot of my premium. Gold better have a big move if I want to make money. So I'm not greedy in the sense that I don't know if I'm going to make 100% within, a day. So I usually put 25 and 50. I'll be happy with 50%. Because I put all those targets, the next day, usually when there's a big move, most of my targets are hit. So if I didn't have it and I came, let's say, around this time of the day, you can see now I'm losing. Basically, my options are just keep going down. So I was lucky at that moment that it opened up almost the high of the day. I covered and I was sold. I was out of my options. And I would say this was about 16 minutes total being in that position. I did the same thing. That was 174 and a half. I also want to go a little more in the money. I also bought 174, did the same thing, and ended up getting hit at the first minute of the market. So that was good. And then after that, I still would have made money if I was like thinking I should make 100, 200%. Why should I keep on? But I would have, not made that much money. So that was another. I also did some natural gas. I was bored. I think, what time was it? It was late at night, and I was just playing natural gas, and basically I did quite a bit of that. Natural gas I would not recommend. Oil is a little easier. The point system it moves pretty fast. It's like 1/10 of a thousand. So every point is $5 or 1/1000th of. So it moves a lot. So basically, you just have to be watching it, and this was more of a Chicago really had a nice day. So natural gas is very much is a weather. It's more than even supply and demand. It's very much weather related. We've had some nice weather back east and Chicago. Then we had really cold weather. For natural gas, one cold day is not good enough. You cannot say, oh, Chicago went from 70 to 40 degrees. Oh, goody, you're gonna. No, you need a pattern of a long term. So that's why these are like ticks. They're not even they're seconds that I was in. But I was just bored. Sorry, I just thought I was looking for something to play, and I just chose natural gas. But I was just in and out. But although they look very close to each other, and you can see I got in because there was this moving. There was this resistance, um, but they're pretty rewarding. I mean, you make good money with just small movements in natural gas. The other thing I did was again a little against my grain. I had sold naked puts on Wells Fargo. I don't know, a month or 2 months ago, I had mentioned there was this a lot of activities on November 20th, 25 options. We were thinking of pinning it, and I thought on the channel, Wells Fargo was at 22 at that time, so I sold 22 puts. That was in the lower channel. So when you sell puts, if you want to do naked, you don't want to sell the put when it's close to the upper band, when it's 25, because you're not collecting much. You want to make sure you're closing it in the lower part of the band so you can collect as much premium. So that's one thing. When the expected move, again, you don't want to be up here. Even if you're bullish, you want to be at least closer to the lower band, thinking that, okay, at least I collect the premium. Even if I'm doing vertical, you want to make sure that there is the lower chances of hitting the lower band, but also you have enough money to justify you doing that vertical. So this was one of the, I think I discussed it maybe a month and a half ago. So that was my Wells Fargo. They expired like at 1 cent or 2 cents. I had also done Cisco. I got lucky with Cisco because of the earnings. They had a good earnings. Now, this one, you can see I'm losing a lot. So my rule is 50 cents, I mean 50%. This is again a no-no. So I want to share with you some of the bad things I've done. But I did believe because of Cisco's movement, and I was looking at the charts, and I I held on to it, and I wouldn't have minded owning Cisco. So these are naked puts, by the way, they are not vertical or anything. Now, I had already planned of owning, if I Cisco hit 35, I would have owned it. So I didn't have, so I already had a predetermined notion that I would be with Cisco. So that's why I was patient with it. And it expired on November 20th, but I think I 5 cents, 2 cents or whatever. So that was again nice trade. And I mentioned about no, but as long as you know your risk, and as long in the beginning you write down what your objective is. Again, my objective was I wouldn't mind owning Wells Fargo, for instance, at 22 or Cisco at 35, then I'm very comfortable with that. Now, if you don't have enough capital, then that's where you have to do like verticals. That's essential. But in my case, as I mentioned, I wouldn't have been reminded. So um, also Petrobras, I had also talked about it about a month ago. There was unusual option activity at 8, and then with all the movement, with everything, with the election, and again with the COVID news, with Pfizer and all as you know, all the energy stocks did well. So I'm not greedy. Actually, it continued going higher. That's another lesson. But I was fine with that. So it was a pretty good rate of return, and I'm done. My chapter's closed, and I go to the next trade. So it was pretty active again a week last week. The short squeeze, I thought again, go back to S&P 100. You really want to be emphasizing more liquid stocks, more volume. I hope you try, playing the short squeeze. At least, I didn't want to give you, these are the basic out of 100. These were the only ones. Um, One of the things about short squeeze, another lesson you have to know, take a look at, these are daily. So daily is very important. The 30 minutes gives you the confirmation, but weekly gives you the big picture. So if you have, let's say we did, and I've looked at Abbott Laboratory also, it's been a candidate of mine. So let's say Abbott, you see it's in daily squeeze. Now, if you go to weekly squeeze and you see, oh my God, it is in the weekly squeeze, and it's like $1 or $2. Usually weekly squeeze stays probably about 6 to 8 dots. So at that time, you don't want to do like the first week, you say, oh, good, it's in weekly squeeze, it's going to expand. So let's do a straddle or strangle on it because it is a squeeze. Usually weekly, it takes time. Just be patient, just wait for the time. If it passes 6 or 7, it's all about the odds. Remember, the Bollinger Bands are narrowing, or they are in the squeeze. You don't want to jump the gun yet. So be patient. So if Abbott isn't squeezed for 1 week or 2 weeks, don't jump the gun. Again, remember, squeeze expands the bands, so it gives you the volatility. But that's just another lesson. So you do the daily, and then if you do watch it, if you see it looks good, go watch the weekly. If it's been in squeeze for 6 or 7 weeks, then you know it's ready to go. As I mentioned, it's about 8 bars is the average. It goes up to 12, but 1 or 2 squeezes for weekly is not good enough. Okay. Last but not least, the earning season is coming to an end. It came, the big boys are already out. So these are just some of the ones that if you want to play, earnings option plays, then this will be some of them that you can, especially like Medtronics and medical devices or Agilent technology or WinWare. So anyway, with that in mind, I really appreciate your patience. Sorry, I went a little over, but I thought, the week before Thanksgiving, I thought it would be a good idea to just review the things. As I mentioned, I want to wish you a wonderful Thanksgiving and wonderful holidays, my favorite holiday. And with that in mind, what I'm going to do, I'm going to stop recording and